Hi, David Moore, Equity Advantage. I've got Robert Smith of Peregrine Private Capital, and we're talking about a variety of things today, but we've got a sort of a pea soup full of acronyms that we deal with in life all the time. FBI is one that comes to mind right now, but anyway, in the exchange world, DSTs, TICs, you got two different types of DSTs and all. See, I got them laughing. I love it. But we started looking at DSTs and TICs, for example, and people have lots of questions. Well, what are you talking about? We had somebody new that we hired a couple weeks ago, and I was just talking to her, and it sort of came to me. It's like all these things that we just sort of talk about, second nature because it's our world. But when you're talking to people, just walking down the street, to get them to really understand the difference between things. And I think the DSTs, we've got deferred sales trusts. We're not talking about those. But we're talking about Delaware Statutory Trust, and when we talk about TICs, a TIC's just tenancy in common. It's joint ownership of an asset. And DSTs could be a single asset or multiple assets, where the TIC's going to be a single asset. But would you mind just clarifying for the audience a little bit the difference between the TIC and the DST, and so people understand? And maybe, first off, both of them are securities.
Both of them are securities. The DST is exclusively securitized, meaning you have to have a securities license to sell them, whereas TICs can be securitized, but they can also be sold by commercial real estate agents. They're both multiple ownership formats for real estate. The principal difference being is management is the participation. I think TICs are limited to something like 35 investors. 35. So the aggregates that go into it tend to be a little bit bigger, whereas DSTs, you can, even though there is a limit, you can pretty much slice them and dice them any way you want. As long as there's available equity remaining for investors. And I think the critical difference, and it really showed up in 2008, is in management of the property. For a tenant in common property to have anything done with regard to the property from a management standpoint, tenanting, anything like that, you have to have unanimous decision on the part of all the investors. And if you've got a small group of investors, that's not a difficult thing. But if you have a large group of investors in a larger property, it tends to be, it's like herding cats. It's very, very difficult to get everyone on the same page at the same time. And because they're both remote from a management standpoint, people historically have gone into DSTs and TICs because they want to get out of the management loop. And in times of crisis, when decisions have to be made quickly with regard to a property to maintain its stability and functionality, that historically has been difficult to do with TICs, because you've got people at point distant, and even when you can get them back on one page, all on one page, there's always an outlier, a spoiler that just likes to stir the pot. And so it was very difficult for decisions to be made in a timely manner with TIC properties in 2008, 2009, and that's why many of them went down. Then with the DST structure, management is vested exclusively, the day-to-day operation of the property is vested exclusively in management, and management's also going to make the decision as to when the property is sold. You're just along for the ride as an investor, and if you're going to buy into the remote ownership format, you want that decision-making vested in management, because they're professionals, at least at that level, you're probably not. And so you don't want to have to get all the investors together to make that decision. You want the decision to be done in a unilateral fashion. It just works better, and that's why on the securitized side of things, everything is in the DST format now.
So I just want to stress to people out there, though, that, I mean, tenancy in common sort of started off with, let's say the two of us go buy a property in Sun River and use it, right? And then it sort of grew from that into a situation where you maybe had a broker, compile a group of people to go buy something, and then it ended up in the institutional world. But I want to stress that a tenancy in common property, you should have, just like you would with a limited liability company, you should have a TIC agreement, tenancy in common agreement, spelling out the management of the asset, all that's happening. Because, the two of us go buy a place in Sun River, 5 years from now, it's like, okay, you're skiing all the time, I'm not, I don't want it anymore, so I want to sell mine. You'd probably like first right to buy my portion, or at least control somewhat who comes in. Or if I'm triggering a refinance of the property because I want to be released of it, it's going to cost you some money. So that TIC agreement would spell out all those things and how it all works. You made a comment during the last crash that the problem that happened with some of the institutional TICs was that you made the comment about you got to get everybody unanimous decision on selling something. So if there's one person that doesn't want out, that's where we saw a problem. They thought, no, we don't need to. We can fix it. We can save it, whatever it might be. And that's where that problem was. But so I see, obviously if I'm looking at a situation, the other thing that comes up is if the two of us go buy something, I'm not really worried about the security issue of it. But if, let's say there's 5 of us that get together, and let's say I put the group together and it's passive for everybody else, if it's passive for you guys, it's a security. Whether you look at it or not, it's a security. So I would just caution the people that want to compile, get a group of people to go buy something, and you're going to do everything for it. You should do yourself a favor, talk to your legal people, and get the paperwork in place to protect you, because there's something called the good deal exemption. As long as things are going great, everybody's happy. The deal goes south, and if you've put a group of people together and it's passive for those people, it is a security, whether you want to call it that or not. So I just want to stress that. But where I see the difference typically is the TIC structure is used in value add situations. Correct. From my perspective. So value add means they're going to buy something. They're not just looking at the cash flow off the asset. You're buying it. You're going to do something with it. It's not a stabilized asset where the DST is. And it has to be, right? So the TIC stuff, we might have recourse or it might be non-recourse debt on it. But the idea is you're buying the asset, certain things are going to happen, it's going to increase the value over time, you're getting a check in the mail, so on and so forth. But you've got to understand what that TIC agreement says and how it works, where the DST, stabilized asset or pool of assets, and it's non-recourse debt and no capital calls.
Non-recourse debt because the lenders believe that they are over-collateralized with the DST format, and obviously the leverage level varies. It's been going down as the cost of money is going up. It used to be right around 50% loan-to-value ratio was the average in the DST space. Now it's hovering between 40 and 45%, and so it is interest rate dependent, but again, because the banks feel they're over-collateralized, or lenders feel they're over-collateralized on the asset, it is non-recourse debt, which is the best type of debt you can get, because there is no recourse to the investor outside of the equity that he or she has in this property.
So he just said something about LTV. So the LTV is another acronym, right? Loan to value. So if we look at, you're saying that today the DST sort of average is around 50% loan to value?
No, it's dropped a little bit. It's hovering between 40 and 45%.
Okay. So a lot of you out there might have been told through the years, you got to replace debt in an exchange. You got to replace debt in an exchange. Well, what happens in recessionary times? You've got typically a decreased amount of equity in a property, and you've got a decreasing LTV, loan to value, on these things, what's available. And so people are faced with a situation where I've literally been asked, well, I'm not going to have any debt on the replacement. Do I have to pay off the relinquished property predisposition? My answer is absolutely no. Debt can go away 2 ways in an exchange. Debt can go away by going down in value, triggers tax because you went down in value. The other way debt's going to go away is by adding cash. So if you're going into one of Bob's projects here and it's 50% loan to value and you gave up something that was 60-70% loan to value, you do have some zero coupon things that you might want to mention that bring up some of that, but you can always add cash to the transaction. So if you're in a situation where you're giving up a property that's 50% loan to value, you want to buy the replacement property outright, that 50% that was attributable to the loan, you just come out of pocket that money, you're totally tax deferred, and yes, you went from a lot of debt to no debt, and there's no tax because you met the value requirement. I just want to stress that. So you're going to look at what the aggregate value of everything that was given up and what you're receiving. And if you're talking to Bob about this stuff, he's going to say, okay, well, we've got this project that's this LTV, this one that's this, and you're sort of going to work with them to get to the aggregate LTV they need.
Right. You can. We have a product in the DST space called the zero coupon DST, and it mimics the structure of a zero coupon bond, where the property is very, very aggressively leveraged, 70, 80%, usually has a single institutional quality tenant, and like a zero coupon bond, instead of paying out on a monthly basis to investors, the rental income generated the property is paid back into the property, retiring debt in a very aggressive manner. So you're not receiving monthly income, but you're building up equity, and the deals are usually structured in such a manner to protect you from phantom income. And that product was specifically designed to be used in a piecemeal fashion for investors who are coming out of sales where they have a higher loan-to-value ratio replacement requirement than may be currently available in cash-flowing DSTs in our space. So you can take say you've got a great senior living property in Florida and it's cash-flowing at 6%, but the LTV is only 45%, and you've got a 60% LTV replacement requirement on your exchange, and you don't want to add any cash. Well, you can take some of your equity and dedicate it to that zero coupon product, peel off a piece of that, add it to your cash flow DST property, and the blended LTV then meets your replacement debt requirement. So there is some flexibility in the space in terms of meeting those requirements.
Yeah, we've been doing some work, as I've spoken to you about recently, with Eckerd Oil and Gas out of Houston. And their products all zero leverage, right? So I have put to them, I said, look, you guys take care of that piece. People buy into it. They got zero debt, but you pick up the debt on the zero coupon on your side of it. And I think it's a great combination where if people want to diversify, and we were talking earlier about diversification and different things, but if they want to go do that you can give them the debt component, or at least a piece of the debt component they need to make them whole. And I think that's a great marriage, of two different things, two different ways to diversify even further into that space. But once again, David Moore with Equity Advantage, Robert Smith, Peregrine Private Capital, and don't go away. We've got one more segment we're going to work on today. So thank you very much. See you soon.